In this episode of The No Show, we're going to teach you how interest works. What is interest? Interest is the cost of using someone else's money. You either pay it when you borrow money or earn it when you save or invest money. It's typically expressed as a percentage of the original amount, known as the principal. There's two main types of interest. Firstly, there's simple interest. This is interest calculated only on the original amount, the principal. Here's the formula for simple interest. Principal multiplied by interest rate multiplied by time. Example: if you invest $1,000 at 5% simple interest per year for 3 years, $1,000 multiplied by 5% multiplied by 3 years equals $150 in interest. The second type of interest is called compound interest. The concept of compound interest, or interest on interest, is that accumulated interest is added back onto your principal sum, with future interest being calculated on both the original principal and the already accrued interest. This compounding effect causes investments to grow faster over time, much like a snowball gaining size as it rolls downhill. So your money grows faster over time. The formula for calculating compound interest is P equals C, a 1 plus RNNT, where C is the initial deposit, R is the interest rate, and N is how frequently interest is paid. T is how many years the money is invested, and P is the final value of your savings. If you are not that familiar with equations, you do not need to worry about trying to plug in all the numbers yourself, as several tools exist online that can do it for you. Example: $1,000 at 5% compound interest for 3 years becomes about $1,157.63. That's more than with simple interest because each year's interest gets added to the total before the next interest is calculated. Interest when borrowing. When you borrow money from a credit card, bank loan, mortgage, or payday lender, you're expected to pay back what you borrowed plus interest. Credit cards can have high interest rates, sometimes over 20%. So if you don't pay your balance off, debt can grow quickly. Mortgages and car loans usually have lower interest, but because you pay them off over years, you can still end up paying thousands in interest. Interest. When saving or investing. When you save money in a bank account or invest in things like bonds, the bank or company is borrowing your money and pays you interest in return. Some accounts pay monthly or annually. Compound interest helps your savings grow faster over time. Even small differences in rates make a big impact over years. Why it matters. Interest can work for you, growing your wealth, or against you, increasing your debt. Understanding interest helps you choose better savings and investment options. Avoid bad debt traps. Take control of your financial future. In short, interest is money in motion. Use it wisely, and it becomes a powerful tool. Ignore it, and it can cost you big time. Follow our series, The No Show, for more useful information.